and welcome back to another episode of Just for Funds here at the Nasdaq market site. I'm Danielle Rutsky, ETF Product Manager at Nasdaq, and today we are joined by Steve Schoffstall, Director of ETF Product Management at Sprott. Thank you for joining us.
Thanks for having me.
Yeah. So Sprott recently launched an active gold and silver miners ETF. What can you tell us about the strategy?
Yeah, so back in February, we launched the Sprott Active Gold and Silver Miners ETF, ticker GBUG, or GBUG as we refer to it. It's the only active ETF to provide focused exposure to gold and silver mining companies. Those companies are miners, exploration development companies, streaming and royalty companies. We do also have the ability to invest in other precious metals companies, but usually that's less than 5 or 10% of the portfolio.
So with Sprott's 4 decades of experience in mining and metals, how does that experience reflect in GBUG?
Yeah, so our firm really, the underpinning of the company really is in the precious metals and mining space. And the investment team that we have on GBUG actually has over a century of experience within that team and includes an economic geologist. They conduct over 200 management team meetings a year, up to 30 site visits going all around the globe, looking at the different mining companies. What they're really looking to do is to bring that experience back, and they'll meet with the management teams and understand what their capabilities are, the capital needs and structure of the company. They also have a proprietary model where they'll look at price sensitivity and costs and taxes and things like that. What we find in particularly the mining sector is that it's ripe for active management in our view. Typically what you see is an industry that's very complex, very difficult to understand, and this is where experience really comes into play. Just to give you an idea what that looks like, over the last 5 years, on average, we've seen the top performing gold mining company outperform the bottom performer by about an average of 170% a year. So at its core, the strategy is value-oriented and contrarian.
That's amazing, and it seems extra important with this market uncertainty causing market volatility. And with that volatility, how should investors be thinking about gold specifically?
Yeah, you know, gold in many cases is not only billed as a long-term investment, but as we're seeing now with the current volatility, it really does have that insurance type characteristics that it brings to a portfolio. What we see just year to date, kind of how that's paid off, the S&P is down about 15% year to date. We actually see gold's up about 14%. When you look at gold miners, they're up an additional 10% over the physical gold, so about 23, 24% is what we're seeing from performance there. Typically what we see in these very volatile times, like we're currently going through since tariffs have been announced, is that gold tends to sell off in the early stages as investors are looking to raise capital to meet margin calls and things like that. But it typically rebounds much faster than the broader market and typically runs a lot further, is what we've seen throughout history. So in periods like this, that's where we really see gold paying its dividend.
Besides the amazing performance that you're referring to, why might an investor now want gold miners in their portfolio?
Yeah, there's a couple things. So one would be diversification. When you look at gold miners versus the S&P 500, you tend to see, and not even just the S&P 500, but other broader asset classes, there's a low to moderate amount of correlation, actually a negative correlation to the US dollar, which is becoming increasingly important now as we see governments are moving away from US fixed income, moving away from the US dollar. That diversification is quite important at the moment. Also relative to the S&P 500, what we see with gold miners is they typically tend to be more profitable. There's less debt and leverage on the books. They have higher dividend yields. And on a relative basis, they're actually quite undervalued relative to the S&P 500. So all of these kind of characteristics are, we tend to look at the gold miners as a way to kind of dial up and dial down gold exposure. But we see in these times it can be beneficial too when you're looking at those low correlations.
And is there a benefit to being active? What is the difference? Why might an investor want to be in an active strategy versus a passive allocation or a straight gold allocation?
Yeah, we really look at those as complementary strategies. Typically, we think of gold as the physical gold component as the base of the portfolio for the gold allocation. From there, we see investors really dial up and dial down the equity exposure. And from there, you're left with active and passive. As we talked about the dispersion and the complexity of the underlying market, we think active can make sense in a lot of cases for a lot of folks, particularly if investors are comfortable with that active manager risk that active management comes along with. On the passive side, for investors that don't want to take on that active manager risk and are content just taking a broader based approach, we also see that as having a role in a portfolio as well.
Amazing. Thank you. It was great to learn more.
Thanks for having me.